Well, good morning and welcome to the Reserve Bank. With me, I've got Grant Spencer, and as you all know, Grant is the Deputy Governor and he heads all the financial stability work in the bank. New Zealand's financial system remains solid, remains sound. The banking system is well capitalised. Funding and liquidity levels are above required minimum levels. The volume of non-performing loans continues to decline, and stress tests of the major banks' portfolios indicate that the banks have considerable capacity to manage various shocks. The financial system faces four key risks. We reported on these in the May Financial Stability Report, but the balance of risks has shifted in the last 6 months. The four main risks relate to imbalances in the housing market, high indebtedness in the dairy sector, the implications of a slowdown in Chinese growth, and the banking system's reliance on offshore funding. Pressures in the housing market have eased since the introduction of loan-to-value restrictions and the rise in interest rates. We've always indicated that the LVR restrictions are a temporary measure. We welcome the reduction in house price inflation and the slowdown in the growth of housing credit. We also welcome the increased residential building. But there remains a risk of a resurgence in house price inflation, especially with the strong immigration flows. Consequently, we don't consider it appropriate to ease LVR restrictions at this time, but we will continue to monitor the housing market closely. Let me hand over to Grant for his comments.
So while housing risk has reduced, risks in the dairy sector have increased. Forecast dairy payout for the coming season has been reduced significantly and could result in rising loan defaults should the lower payout level persist. Lower dairy prices are in large part due to reduced demand in China, highlighting New Zealand's vulnerability to a slowdown in the Chinese economy. Risks arise both from New Zealand's large volume of trade with China and also from any broader financial market disruption that could result from a Chinese economic slowdown. The other key systemic risk is the banking system's reliance on offshore funding, and this has reduced in recent years, but the banks remain susceptible to volatility in international funding markets. On the regulatory front, the bank is currently undertaking a stocktake of its regulatory framework to improve its efficiency and clarity. Initiatives are also underway to better measure and define bank capital adequacy. And these include a benchmarking exercise for the large banks' internal capital models and the development of a comprehensive stress testing framework. And finally, a review of outsourcing policy for banks is also underway. Thanks.
Well, thanks very much. Very happy to take your questions.
In terms of, sorry, just wait for the microphone. Sorry.
Yeah. Just in terms of keeping an eye on the housing market, I mean, as you say, the LVRs are having an effect, but you're still worried about potential stress or pressure in the housing market, particularly from immigration. So what do you need to see before you'll feel assured that you can actually drop those restrictions?
Well, I think the key thing is we want to see house prices move much more closely in line with the growth of nominal incomes, and for that relationship to be maintained over the longer term, or not to increase, be on an increasing trend over the longer term. The migration has been a surprise. I mean, net migration flows in terms of long-term migration is currently running at around 46,000. I mean, 2 years ago, that was pretty close to zero. So I think most forecasters have been pretty surprised about the strength of migration. And if you look at the relationship between house price cycles in New Zealand and migration flows, there tends to be quite a strong relationship. And you saw that, for example, in 2002, 2003, when you had that migration surge that started to kick off the housing cycle. And that was a very strong cycle. I mean, in that period, 2003 to 2007, we had the most rapid house price inflation of all the 35 OECD countries. So the migration has been a surprise, and we've been looking at the market accordingly and thinking about the risks. Were these LVRs to be reduced in some way, perhaps phased out over time, what would be the price response at this point in time with such strong migration?
Two questions relating to LVRs. Firstly, the rate of high-value LVRs, I believe, have increased from about 3.6% in March to around 7% now. Does the Reserve Bank have any concerns about that increase? Second question, and it's more a political one, opposition parties across the road made much last year after the LVRs were introduced about the impact on first-home buyers. I notice it's referenced in the report. What impact do you think LVRs had on first-home buyers?
Yeah, the fall in the LVR lending, if you like, as a share of total mortgage lending, did fall to around 3.5%, and you're correct, it is around 6.9 or 7% at the moment. I mean, we set the limit at 10%. We also had conditions about in relation to social housing, welcome home loans, for example. That increased that to another 5%. I think bank management and boards of directors have been appropriately quite conservative to try and keep a buffer below the 10%. So, you know, the increase from 3% to 7% doesn't concern us in that sense. We did set the limit at 10 after all. First home buyers. I mean, what's happened is that if you look at the volume of house sales, they've fallen probably around 13% or so over the last 12 months. But if you look at the share of first home buyers in those house sales, and there's some very good data by CoreLogic, basically, if you take the period over the last 5 years, then first home buyers have accounted roughly for about 19% of house sales on average over the last 5 years. It's currently around 17%. So although the volume of house sales is down quite significantly, say 13 or 14%, the proportionate reduction in terms of sales to first home buyers has only declined from about 19% to 17%.
Governor, you cite increased dairy as an increased risk around there. Is there any thought to putting on ratios or restrictions on lending to the dairy sector at the moment?
No.
Also, is it still the same proportion of debt tied up in a small group of farms that you're seeing in that sector?
Yeah, the dairy debt is roughly around $33 billion, and roughly half of it is owned by or owed by 10% of the farmers. That's still the case. And roughly 70% of that debt is floating interest rate debt.
Are they still largely the corporate farm owners that you're seeing in there?
Increasingly corporate, but I'd also say that, you know, with the high prices in last season, a lot of debt was paid down, and so farm prices have picked up a bit over the past year. So average LVRs on dairy debt have probably reduced. So the safety, if you like, in terms of the buffers inherent in agricultural and dairy farm debt have improved.
Governor, to what extent, now that you've moved monetary policy to the sidelines for the time being, at least, to what extent was it necessary to keep the LVR limits in place as a sort of a de facto monetary policy leaning into the market headwinds?
Yeah, that wasn't a major consideration, but I think it is fair to say that had we not moved on the loan-to-value ratios, then it's quite possible that that the OCR may needed to have increased by something of the order of 25 to 50 basis points, perhaps closer to 50 basis points, and that would have put upward pressure on the exchange rate. I think that's fairly clear in terms of capital flows that would follow. But it wasn't a major factor in this consideration. Our main concern has been house price inflation nationally has come down from 9.8% to half that, to 4.9%. And we really, at a time when we're starting to get house price inflation moving at about the pace that we would like it to go, or in fact we want it to come down further, particularly in Auckland, we don't really want to see house price inflation get out of hand again.
Do you think it's possible that the high LVR speed limits could be relaxed next year? And what sort of change in house price inflation would you expect to have that to cause that easing?
Well, I mean, one thing to keep in mind is that you've still got strong house price inflation in Auckland. I mean, it's running at 8.5% in terms of the annual increase based on a 3-month moving average, if you like. The IMF did some work last year which looked at countries and to what extent house price to income ratios out of line with their historic averages. And for New Zealand, that the increase was 65%. And we, along with Norway, were the two countries that were most out of line. So many people, including the IMF, the OECD, Standard & Poor's, Moody's, etc., would say that house prices are expensive here. They're out of line with historic standards and they're out of line with international comparisons. We're pleased the way that house price inflation is starting to moderate as a result of the LVRs and also the interest rate increases. But the prices still remain high, and our concern is that with the lack of supply or the slowness with which supply is coming on in terms of new sections and house building, etc., that if we remove the LVRs at this point, then you really run the risk of house price inflation starting to increase. So I won't give a time in which we will ease these restrictions, because we'll probably ease rather than remove them outright. And we're conscious that many governments, when they've introduced LVR ratios, have kept these on for long periods and they've become almost permanent features. That's not the intention. But we are looking, as I say, at the migration flows carefully and what's happening to Auckland prices and prices in Christchurch and one or two places elsewhere.
Could I just clarify, when you say you'd like to see house price inflation more in line with income growth, are you basically saying you want to see house prices in Auckland rise no more than 4% a year? Is that the key to this? Well,
I think as I say, if you look at the house price to income ratio for New Zealand as a whole, and you compare it to what our historic average has been, we're about 65% above that historic average based on the IMF analysis. And the OECD did similar work about a year ago. So we would like to see house prices over the long term, and this is really talking about the long term, increase no more than the rate of nominal income growth. Now, hopefully, as we start to get the supply response coming in terms of increased building and the special zones up in Auckland and the like, we'll see some better balance in the housing market in terms of the supply and demand.
So the 4% income growth, is that a
It's
fair
not a fixed
benchmark?
threshold, no.
No, it's not a fixed threshold in that sense. Let's say the economy has potential output growth of, say, 3% as an annual rate of potential output growth, and let's say that we achieve a inflation objective of 2%, the midpoint of the target range. Then I'm jumping in logic a little bit because I'm talking about a CPI deflator instead of a GDP deflator. But let's say nominal income growth was 5% over the longer term. You wouldn't want to see house price inflation on a longer term basis increasing more than 5%, I don't believe.
And just a point of clarification on timing, I think in May you said that the restrictions would go at the end of this year at the earliest. Are you able to say, is it the middle of next year at the earliest?
No, I don't think we can give a specific time, but what we can say is we've always seen these as temporary measures. We don't want these to be permanent measures. But what has surprised us, we've been very pleased about the deceleration in house price inflation and what's been happening with housing credit growth. But the migration has been a surprise. I think it's been a surprise to all forecasters. And that's something that we'll be looking at closely.
What is the bank's view on retail bank lending practices given the growth in debt-to-income ratios that's outlined in this report, and particularly the point that's made there that lending of up to 7 times gross annual income to high income earners? Is that responsible?
Well, I think overall lending standards have been responsible. We've been looking at them more closely recently. We've been doing some investigations about debt to income, about debt service ratios, collecting more data. And the situation you're quoting is a hypothetical situation. So there are situations where that could happen, but that's not to say that that's a frequent occurrence or that it's something that we're concerned about or about to impose some restriction. So we're exploring this, and these are the sorts of issues we talk about with the banks in terms of the overall lending standards and the criteria that they apply. But overall, we're satisfied that lending standards are appropriate.
You talk about dairy debt and that being a concern. Are you seeing any reduction in the debt ratios in other rural sectors, such as like beef farms or sheep farms, with prices being slightly higher?
Bernard, have you got any thoughts on that? I mean, about 65% of the agri sector debt is with the dairy sector, so that's where most of it resides. But in terms of trends with other sectors like the meat sector,
all I'd say is, I mean, the latest data we have in terms of borrower in the agricultural sector certainly didn't point to a large increase in lending to the non-dairy parts of the sector.
Yeah, we're not concerned about leverage on some of those other parts of agri.
And you also talk about insurance estimates for Christchurch being between 32 and 37 billion. Any ideas how much of that has been hedged by reinsurance companies?
We think most of that was hedged quite early on in the piece. Now, estimates of total claims have increased over time, and so there'll be some incremental hedging through time, but most of it was pretty early on.
Could you talk a bit more about the discussions with the banks about changing capital adequacy for rental property investors with more than 5 properties? I understand that the change to the capital adequacy rules was delayed until the first half of next year. Can you explain what's the thinking on that delay and what might come out of that review?
Yes, well, we had an initial consultation, and Toby may have some thoughts on this, a few months ago, and we had a proposal, but there were differences of views in terms of how we should view this asset class. We wanted proposing basically a separate asset class of residential property investment and trying to get consistent treatment. But so, different banks have had different treatments, and so it's a matter of finding the one that's most sensible and that the industry is happy with. And so that consultation has been ongoing. We're probably, we're not necessarily, we were talking about a rule with 5 properties. If you have 5 investment properties, well, that we're not so sure that that's the appropriate rule to adopt now. It may be more an income-based rule. But we're still discussing it further with the banks, and we'll be consulting further in the first quarter. Is there anything to add to that, Toby?
That's
yeah. I think, yeah, thanks.
Some other central banks in Australia, this is an issue, have looked at the risks that rental property investors could gear up and push up house price inflation, given interest rates are so low, and it seems that type of investment's very popular. Are you concerned at all about a growth in rental property investing, leveraged rental property investing in New Zealand?
Well, it's something we watch, and obviously it's an important segment of the market, but I would say that right now in Australia, we're not seeing the same thing here that they're seeing in Australia right now. In Australia, a lot of new lending is to the investor part of the market, and they're dominating the Australian market at present, and I don't think that's the case here. If you look at the numbers, it's much more stable. The proportions is not changing as it is in Australia. So we're not overly concerned with that particular pressure.
Could I just clarify a little bit? You say you're not concerned about that, but the graph on page 27, 4.5, shows the fall in first home buyers to about 17%, but property investors up to more than 40%. So they're essentially coming in and taking over from the drop in first home buyers, aren't they?
This is on mortgage commitments. So, sorry, 4.5 you're looking at?
Figure 4.5, yep.
Right. Well, I think there has been some shift, as you can see in the graph. So you're right, there has been a relative shift in the proportion, but it hasn't been that dramatic. It's sort of 35 up to 40% for investor. Movers in terms of existing home buyers has been pretty solid. There's been a reduction just recently, but part of that may be noise. And as we've said, there has been some reduction in first home buyers. But I think in general terms, the reduction in proportion of first home buyer sales has been compensated for by existing home buyers as well as the investor community.
So I guess it goes back to the point, is this LVR experiment basically penalised first home buyers but left the door open for investors?
Bernard's got a comment here.
One point we need to make here is that, as we mentioned before, the value of house sales is down compared to when the LVR restrictions were in place. That dropped around 13%. So although the share of investors is up slightly, the actual amount of investment activity that's going on is actually it's not significantly different from what it was prior to LVR restrictions. The share is up, but the actual activity is broadly the same.
But you're still getting lending growth of close to 5%, right?
Lending growth is not dramatic. Mortgage lending growth is down to sort of 4.5%, 5%. So, that's not a rapid rate of credit growth.
James, if you take figure 4.6, the share of total lending in terms of mortgage commitments by buyer type, you see the investor proportion roughly around 30% or so. I think the latest numbers I was looking at yesterday out of Australia were around 43%. They're seeing a lot of investor activity in the Sydney and Melbourne markets.
You mentioned that you're reviewing bank outsourcing. Could you talk a bit more about the reasons for that and any concerns you have?
Well, the outsourcing policy, I guess it's consistent with the general principle of reviewing our policies from time to time, as we're doing with the regulatory stocktake. The outsourcing policy first was taking shape, back over 10 years ago, around 2002, 2003, around the time of the ANZ National merger. And so it's been in place for a considerable time. So we think it's a bit of a time for a refresh. Different banks have had somewhat different interpretations of, what's a core function, what's not a core function. And we've had an output-based policy or an outcome-based policy where we're not very prescriptive in terms of the set of functions you can outsource, the set of functions you cannot outsource. And so there's been quite a range of outcomes. So we decided to review it. We've undertaken a review of all of the functions that have been outsourced and kept in-house by the major banks. Done that over recent months. We've looked over the results of that. We're talking about it with the banks, and we've decided, well, we really need to probably have a clearer policy about what outsourcing is permitted and what isn't. So it's that policy end of it that we'll be developing over the next 6 months or so.
Because there's the risk or the chance that with the new cloud-based infrastructure for computing, that they could evaporate the New Zealand banking system into the cloud if they wanted.
Well, I'd hate for that to happen. And so that's certainly the new developments in technology, as you say, have a bearing on this review, because the sort of things that are potentially going to happen now are not the same things that were happening 10 years ago.
Also, the Financial Markets Authority surveyed savers about what they thought were the safest investments, and 52% thought term deposits were government guaranteed. I wondered what the Reserve Bank thought of those views, and whether it had as a responsibility to inform or educate savers that those deposits are not guaranteed anymore.
Yeah, I think there is a genuine concern about financial literacy, and people don't understand that deposits aren't guaranteed here. You get similar sorts of findings in other economies. If you did a similar questionnaire in the in the US economy, you'd probably get lower results, in fact, in terms of, partly the US in terms of financial literacy in general tends to be pretty low. And less so in Europe, but certainly in the US. There's a debate here about deposit insurance, and should the government introduce deposit insurance? And we in the Reserve Bank have recommended against deposit insurance for several reasons. This is a very highly concentrated banking system. It's dominated by the 5 largest banks and the 4 largest in particular. And when you look at deposit insurance, it doesn't work well in highly concentrated banks where you have the risk of potential contagion and the like. It tends to work well in economies like the US where you have multiple small banks, frequent failure, to be honest, in the US banking system, and the funds that can be built up can be used profitably to protect borrowers in that sort of situation. If you set up a fund here, it would probably take several decades to set up a fund that could seriously protect the deposits of investors. And that then creates a sort of tension in the sense that if a government goes out and says, okay, we're providing deposit insurance, we're going to guarantee depositors in the event of bank failure, but it takes years for that, in fact decades, based on the analysis we've done to build up a fund, then basically the government's written an explicit contingent liability that it will do that. We also worry a bit about the incentive structures it creates for depositors to go out and aggressively look for the highest returns. We also worry about the incentive structures it creates for people in bank managers in terms of risk-taking if they feel that there is this government guarantee. And there are also tricky issues about pricing these sorts of guarantees. So you would want to set the premium for deposit insurance such that it reflected the credit standing of the institution that you're providing that assurance for. And that's become quite a tricky issue in many countries. Often they don't create that differential pricing for credit risk. What you see over time is deposit insurance levels rise, get higher and higher, and that imposes more guarantees for the government. So we've been, our recommendation to the government on this sort of issue when it does come up is to basically say that we don't think it's in the broader public interest to do this.
Doesn't concern you we're the only one in the OECD who doesn't have a deposit insurance scheme?
There's 2 or 3 countries that don't. Israel doesn't. But no, I think the arguments when you've got a small, highly concentrated banking system that basically would require asking taxpayers to underwrite a guarantee for decades while a fund is built up, that I'm not worried that by and large we're in the minority of governments that don't have it.
Deputy Governor, I'm just wondering if you could elaborate on your speech from yesterday. Just curious as to what risks you see around the payments and settlement systems and what's quite a rapidly evolving area, and also just to get an update on the strategic review of ESAS, which I think you guys were going to be putting out this week sometime.
Well, I'd refer you to the speech on our website. You're welcome to read that. But essentially, the main message was that the volume of payments and the complexity of payments is increasing over time, has been increasing over the past 10 years and wasn't really slowed much down by the GFC. In that environment, there has been a strengthening of regulatory standards internationally around payment systems, and that we think there's a need for some strengthening of our system in line with that, although we will continue to be at the sort of non-interventionist end of the spectrum. But we're particularly concerned that we should have the ability to ensure the safety, in particular, of systemic systems. In other words, not just all the small retail payment systems, but the ones that can potentially have an impact on the whole payment system and on the whole economy. And we also would like to improve our crisis management or formalise our crisis management powers in that area. On the ESAS NZ Clear review, we have had a review underway, and there was an update on that released on Monday, I believe, a couple of days ago on our website. And we're continuing with the review. Basically, there's a need with ESAS, which is the exchange settlement account, the interbank system. It's a core function that will remain within the bank, but it needs a technology refresh. And so we'll be putting out an RFP related to that upgrade in the technology. On NZ Clear, which is the central securities depository and settlement system that handles most of the wholesale debt instruments in New Zealand, that is not a core function, and we'll continue to review the possibility for changes in governance arrangements for that system. So that doesn't necessarily need to reside within the Reserve Bank, but if it does move away from the Reserve Bank, we would need to be satisfied on various criteria to ensure the ongoing safety and efficiency of that system. In any case, the NZ Clear system also needs a technology refresh. So there'll be RFPs going out in relation to that review early in the new year. Thanks.
Question about the currency. Your language seems a little less strident than it was a couple of months ago. Do you still consider it to be overvalued, and are you still actively looking to intervene when you think you'd be successful?
Well, I won't comment on the intervention, but yes, we still believe that the exchange rate is unjustified and unsustainable. I mean, if you look at the cross rate with the US, we've moved from roughly 88.40 at the peak to roughly around the low 77, but overnight it's strengthened a bit more into 78 plus. But that's still roughly a 12% reduction in the cross rate. TWI is down about 5%. But, you know, dairy prices, whole milk powder prices are down 48% since February. They're about a third of our manufacturing merchandise exports. So we still think the exchange rate's got further to go. How much it moves, I think, to some extent or to a large extent will depend on what happens with the US dollar and whether we're at the start of a significant appreciation in the US dollar.
You mentioned in your speech yesterday that you want to toughen the regulation around systemic financial market infrastructures, and that at the moment you had to rely on the power of suasion to get them into line. Can you explain for us which are the financial market infrastructures which aren't designated at the moment where you think you might need something more formal to bring them into line?
Well, I mean, it's not a fixed list. It's probably true to say that most of the systemic systems at present aren't come under our designation regime, which is a voluntary regime. And so we have an influence over the rules to make sure they're consistent with our principles for soundness and efficiency. But there are systems that are outside it, for example, SBI, settlement before interchange, is not a designated system. But that can change through time as the shape of the industry changes. So it's more the broad principle. We're not saying there are particular issues around the SBI that we have to get to grips with, because we have a relationship with Payments New Zealand and SBI anyway, and through our suasion and discussions with them, we're making good progress there on the reduction in settlement risk and the frequency of interchange. So I wouldn't pin that as the key objective. I think it's a broader issue.
And you also mentioned the current debate over the future of FPOS and debit with the growth of contactless and these card schemes. Do you think there's any systemic issues the Reserve Bank should think about if we do see people shift away from using direct debit, in particular FPOS, and move towards more card-based schemes, which may be slightly more expensive and also more and based on international systems rather than local systems?
There are potentially safety issues, soundness issues around moving to systems that are international systems. And we see that already in the wholesale space with the clearing and settlement of derivative transactions, where a lot of that is offshore in the large clearing houses. But it doesn't necessarily mean it's an issue that needs regulation, because payments at the end of the day is effectively a global industry, and so we can't just put New Zealand in a box and say you have to do everything here. So it's a matter of dealing and managing those issues that might arise out of the international connection and the lack of New Zealand control over some of these systems. And in the debit issue, we've taken a non-intrusive approach, which is our general philosophy in payments. In other words, to allow market-based solutions. It's a fast-moving industry. Technology and customer preferences need to be the driver, not the central bank. But we want to make sure that those developments occur in an environment of competition and of safety. And so it's those broad parameters that we want to ensure. We don't want to predetermine the shape of the industry or whether domestic debit or scheme cards should be constrained in some way.
Okay. Thanks very much indeed.